So we may be in a recession, but that doesn't mean that we're about to have a major default cycle. So I think that spreads are likely to widen, but we're not likely to get a repeat of the 2008 or the 2000 cycle or even the early 90s cycle where we get a huge widening in spreads.
In December of 2024, the Financial Times reported that the world's oldest bond, a 400-year-old Dutch perpetual note, has paid interest continuously since 1624. The issuer, a water control board near Utrecht, used the proceeds to finance repairs on a water dike. The current owner, the New York Stock Exchange, celebrated its 13.61 euro annual interest payment. For centuries, bonds have financed infrastructure development, wars, economic projects like the New Deal, and good old-fashioned corporate M&A. The world is built upon the movement of credit through the global financial system. I'm Amar Reganti, fixed income strategist at Wellington Management, and this is the Investor Exchange, a new podcast focused on asset classes and forces that drive them. I'll be speaking with some of our foremost fixed income experts about their approaches to these important markets. Before we begin, I'd like to thank my colleague Thomas Mucha and his team for letting us use this feed from Wellington's popular Well Said podcast. We hope to make him proud, or at the very least, not embarrass him and the Well Said team. So with that, I'm joined today by my friend and colleague Campe Goodman, head of multi-sector credit investing. Campe, welcome to the Investor Exchange. Thank you for being here.
Thanks, Amar. It's good to be with you today.
Okay, so across history, upheavals, turmoil, societal change, the bond market's been there through all of it. To me, it's a living, breathing thing that reflects its contemporaneous environment. You've spent your entire career in fixed income markets, well over 2 decades now. How does that resonate with you?
Well, my first thought when I heard that was, this is why you don't care about the corpus on 100-year bonds, because it really doesn't matter. I mean, we're getting paid 13 euros a year. Just goes to show that you care a lot about the early payments.
Yeah, you're not looking at the 70-year forward payment, right? That's not what's really of interest to you, right?
Doesn't really matter, yeah.
Yet, I think it bears not the forward payments, but the current payments, and the system bears relevance to what's happening now within capital markets, right? If you think that the bond market is reflective of conditions, actually like conditions in the present and possibly expectations in the future. I'm looking at a market right now, particularly in credit, that has relatively good yields, spreads that were tight when I first put pen to paper on this, but are moving wider on the back of a lot of policy uncertainty. And we are recording this on what's being called Liberation Day. And they've moved wider, and we've seen a bit more volatility. But yet credit markets feel almost orderly and stable relative to how equity markets feel today. Can you kind of talk me through why and how you see that phenomenon?
I do think it's pretty interesting to put our current position in context of what I've seen in the markets over the last 25 years. When I started in 2000, it was a time when credit markets subsequently went through 3 horrible years of performance. 2000 was bad, and then 2001 was worse with the 9/11 catastrophe and recession. And then 2002 was even worse as we had WorldCom and Enron and some really horrible performance in the fixed income markets. And when I think about what happened there, well, it was a real default cycle. Things blew up and bond spreads widened a lot because there were actual major fears of default in the markets. And then you go forward to 2008 where spreads got significantly wider. And again, it was because there was actual fear that you weren't going to get your money back. So you come forward to today and you say, well, why are, if we're potentially headed into a recession, and I think we are headed into
Oh, okay.
Okay.
All right. That's a new statement I'm glad came out on the podcast. So.
Yeah. Haven't said that before. I actually think we are probably in a recession right now.
Okay.
So we may be in a recession, but that doesn't mean that we're about to have a major default cycle. So I think that spreads are likely to widen, but we're not likely to get a repeat of the 2008 or the 2000 cycle or even the early 90s cycle where we get a huge widening in spreads.
Oh, okay, I want to dig into this recession point and the default cycle. So 2001, there had been a set of assumptions, not just about the dot-com market, but the overall strength of the economy, and as well as like corporate reporting, right? When it came to like WorldCom and Enron, all of those assumptions had to be changed and recalibrated, and a default cycle was in full swing for several years, I think. It was like at least 2 years, right, where things were ticking up. And in '08, it was what Richard Koo would call a balance sheet recession, right? The credit impulse within an economy. So refinancings, collateral valuations, all were sort of jeopardized. Can you have a recession in a weaker economy and no default cycle in the sense of the ones that most credit market practitioners understand?
Well, that's a tough one, but I'd say you'll get a higher default environment, but I don't think you're going to get the type of major default cycle that we saw during those previous periods. There are two major differences I'd point to. One is that corporate balance sheets are just so much better than they were in those previous periods. As you look at just statistics like debt to cash flow or interest coverage. And the other reason is that in those past cycles, a lot of the brokerage firms were highly levered in a way that they're not today. So we always used to talk about how the banks and brokers were supposed to be providing liquidity to the markets, but every time we got into one of those situations, it was more like they were the big guys in a crowded theater when somebody yelled fire, and they were shoving you out of the way to get out the door before you could. So I think it's very different today.
Yeah, actually, that's funny. Following the GFC, one of the critiques of a lot of the reform and Dodd-Frank and Volcker rules was this would inhibit liquidity. And the pushback was these weren't institutions that were stepping in the way to mop up liquidity when there was, correlated selling across markets.
It inhibited day-to-day liquidity in normal markets, but it made the probability of a major crisis, I think, lower. So I thought it was a good move for them to essentially be forced through regulation into reducing the size of their balance sheets.
So from a recession perspective, I assume then that you're viewing the hard data catching up with the weakness of the soft data in a relatively near and intermediate term period.
What I think is going on right now is that we've introduced a significant amount of policy uncertainty into the economy. And I should say just, my disclaimer here is this is not a political view. This has nothing to do with what I think politically.
Disclaimer noted.
But I just think the facts are that we've created significant uncertainty. Whether or not we go ahead with massive tariffs, whether or not we actually fire a bunch of people out of the federal government or whether they get reinstated by judges, whether or not we continue to make large disbursements to all of the universities and hospitals that are expecting to get federal payments over the coming year. It's really hard to say whether those things are going to happen or not. But what we can say is that it's created an environment where it's much harder to plan. Businesses are more reluctant to hire. Consumers are nervous about spending. And so all of that is causing it just a shift in the environment. So far, we've really only seen it in confidence. We've seen it in a decline in hiring, but we haven't seen a pickup in firing. But I think as we move forward here, that policy uncertainty is going to translate into economic uncertainty. That's going to translate into a lower level of activity. And I think we are just starting to see that now. You're seeing it in some of the advanced GDP now numbers and things like that. But I think we have farther to go. Now, the big question then is, does that translate then into a large enough decline in profits that we see corporate defaults pick up? And I think the answer to that is going to be somewhat, but not to the degree that we've seen in past recessions. So I think we are in a mild recession, but it is a mild recession.
Okay, so if we're threading that needle, right, how do you kind of think about navigating this in your day-to-day?
I think that we are shifting from an environment where the Fed was likely to keep rates stable, on hold because growth was steady and the risks were tilted towards higher inflation, towards an environment where the Fed is going to be more willing to cut. I believe that we're entering an environment where the Fed probably will start talking about lower rates. They've been reluctant to do that because they've been concerned about inflation, but they believe, and I agree, that if demand comes down, then inflation will fall as well.
So overall, lower rates is how you're viewing.
Lower rates.
Yeah.
Yes. And yes, somewhat wider credit spreads. Again, I don't think we're going nuclear on credit spreads here, but they ought to be wider, incorporating more of a risk premium.
And you think the opportunity set is a bit more leaning toward domestic, or are you looking a bit more abroad?
I think that some of the best opportunities are likely to be outside the U.S., in Europe, in emerging markets, especially emerging market corporates. And within the U.S., I think the opportunities are better in structured product than in the corporate sector.
I keep saying this, but it's true because you've been doing this a long time. What do you think a lot of credit allocators often overlook?
Yeah, thanks for the reminder that I've been doing this
It's
a long
okay.
time.
You don't look like you've been doing it that long.
I think the first thing that I'd say a lot of allocators overlook is that they don't consider a broad enough opportunity set. Many of them are restricted to just looking at the U.S. or just looking at corporates. I do think that one of the things that I've really been able to do over time is take advantage of Wellington, where we have so many different opportunities that we can look at. Some of the things where we think there's value are things like emerging market corporates or convertible bonds. Those can be tough opportunities for a lot of allocators to take advantage of.
I mean, that's human in a way, right? You come up as the high yield guy, let's say hypothetically. You look at the world almost inevitably through like a high yield lens, and it's hard to kind of break away and look like more broadly. Is that right? Is that a thing that can happen to risk takers?
Yeah, you never forget your first love. And so it's hard to fully move away from that. So I think that can be a real challenge. I also think that it's often the case that investors get a little too focused on strong fundamentals. I tend to place a pretty heavy emphasis on valuation. A good example of this is over the past couple of years, U.S. high yield has had such a low default rate, and Europe has looked less attractive. But European spreads were wider, and I think incorporated that difference in fundamentals. Now, as things are changing, in Europe, you've got wider spreads and improving fundamentals, whereas in the U.S., you've got tight spreads and deteriorating fundamentals. We're starting to see that gap narrow.
The thing I'm going to bring up is one that we could probably devote a whole podcast to, is thinking about how your world has been impacted by the rise of private credit. And it wasn't a big feature 2 decades ago. And now it seems like it's grown into its own sort of channel of the global credit impulse. And how do you think that impacts public markets? And do you think it's helpful to you, or has it been a hindrance to achieving what you want to get done?
Okay, I'm going to give my answer, and then I want to hear your answer too.
Okay, fine. Yeah.
I think private credit has been largely a replacement for what the banks used to do. I think it has picked up a lot of the slack in terms of banks are doing less of that lending, and so private credit has found it very profitable to get into that space. Insofar as that's what's going on, it's generally good. It's providing capital that used to be provided by banks. That said, it's less transparent than banks ever were. It's less regulated. It is untested through a real default cycle. And I think there has been this assumption that private credit doesn't need to be backstopped in the same way that banks did, and therefore it's a good thing. But we have no idea whether that's true.
So I agree with you. I mean, there's some good things that I've seen arise from it for the system overall, which is in 2023, I think we would have had a lot worse tightening of financial conditions if the private credit channel hadn't been there. We had a bank run, which sounds crazy to say, in 2023. Corporate credit officers at banks started tightening conditions, spreads moved wider. We should have seen a slower kind of economy. But the private credit funds just kept raising capital and deploying it. So you had this, I don't want to call it a shadow bank, but it felt like a shadow bank injecting credit into the economy. And that was, I think, a good thing. It stabilized the U.S. economy and worked in a counter-cyclical fashion. And now there's a growing connectivity back into the regulated market of banks and insurers who had initially kind of, at least the banks shed that side of the business, but now are coming back in different ways, whether it's providing leverage or taking stakes in LPs. And to me, then, what you're doing is connecting something that has less transparency back into the regulated credit creation channel. And I don't know what that looks like if we do have a worse slowdown. That's my thought on it.
It's so opaque, Amar. I mean,
Yeah, I don't know if there needed to be some type of emergency intervention in markets for financial stability purposes, I don't know where that intervention could actually take place, right?
That's a big question.
That's a very big question.
This is sort of your area. So like, what's your guess on how we would actually do that? Would they bail out one of these big private credit funds, or are they going to provide some kind of stability fund? Can they even do that legally?
I don't know. I mean, it's a great question. I mean, I was around the folks who worked on Dodd-Frank Title II, which was the unwinding, orderly liquidation of a large financial institution. It's unclear how that would be applicable to something like a private credit fund. I assume there would probably have to be some type of sector-wide type of facility because they can't pick and choose individual funds. The very thing you and I talked about, the lack of transparency, how do you even value the collateral? Like, you're back to that 08-ish problem. I'm not saying it's like 08, but one of the big issues was no one knew how much something was worth. And that was a huge issue. So like, getting back to that, I think is very hard. Maybe we look back to the early 90s, like Resolution Trust.
Right.
Yeah, like the post-SNL kind of intervention.
That's a good example.
Yeah. What tail risk is then keeping you up at night if we take the private credit discussion out of the picture?
I do think that the real tail risk here is that due to this uncertainty or some kind of policy mistake, that the economy slows much more than what we're expecting here, the U.S. economy in particular. And part of what has helped the economy over the last few years has just been very strong confidence from businesses and consumers. And also, there's been a lot of policy support. And we're literally cutting confidence here. We're cutting spending. And we have no idea how much that has underpinned the economy. And this is a tail risk, is that we have like a Wile E. Coyote moment here where all of a sudden we look down and there's absolutely nothing supporting us, and we have a much more substantial recession.
That's something one could lose sleep over really easily. I also wonder if we're now talking tariffs on goods, whether the concept of tariffs on capital controls or frictional costs.
The other thing that scares me is that I say Wile E. Coyote and half of our audience has no idea what I mean by Wile E. Coyote.
Yeah, well, you can't be experienced in this market and still hip to the best way to speak to, pop culture. I don't think those things intersect. Okay, I'm going to end on one last question because we started with history and we can look to the future. But thinking back over the last 20 plus years, is there a day or market event that you remember vividly? And what are the lessons from that moment that you think you'll utilize ahead?
I think I do want to go back to that early 2000s period. I remember there was one particular day in 2002 when the high yield markets were just getting absolutely bludgeoned. And it was the worst day, month, year that I think anybody had experienced. And late in the day, the sun began to set, and down in like the high yield side of the room where all our high yield investors were, there was just this beautiful blood red sunset that was shining brightly through the windows. And one of our smart aleck mortgage portfolio managers, who was feeling much better about the world at that time, looked down and said, "Hey, look, I think the whole high yield position just went supernova." And it just felt like everything was melting down, and it was terrifying. But at the same time, I saw the best investors that I knew stay steady, hold their positions, buy more. And it was a great lesson that we get through some of these things. They do bounce back. Markets correct over time. And you've got to be willing to stay calm and confident during some really terrifying times.
Great lesson about staying calm. And ironic that it was the mortgage guy who said that, because his time would come in a few years.
Yeah, great point. It sure did.
Camp, you've given us a lot to think about. Thanks for joining us today. So once again, Campe Goodman, head of multi-sector credit investing here at Wellington Management.
Thanks, Amar. It's always fun to talk to you.
The Investor Exchange podcast is a production of Wellington Management. Our producers are Mark Murphy and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Production support from Dave Crow and Rasa Sermont. Animation support from Rasa Sermont. You can listen to the Investor Exchange at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.